But one stock which has really made a roaring comeback in the year 2013 is Escorts. Escorts is one of the best performing auto stock for 2013 and is up 88% in this year. What is in store for 2014? What we should expect from the company, and what is the management likely to declare for 2014? Let's discuss that with Bharat Madan, Group Financial Controller with Escorts, who joins us live from New Delhi. Bharat, good morning and thank you for joining us. Is the management of Escorts excited that markets are finally giving the company its due? The stock is up 88% this year.
Yeah, I think the year has gone pretty well for Escorts. So the industry has done well, and we have also been able to improve on our margin front. So overall, I think it has been a good year for us, yes.
One of the largest investors over the weekend, and his thought is that for Escorts, the big story in 2014 could be margin expansion. Currently, our margins are at 12%. They could easily move to 14 or 15%. Is he right in his assessment? Are markets right in assuming that for Escorts, margins would move up?
Yeah, that's what we have been telling the investors in the market, that this is what we are focusing on as of now. So we have been able to improve the margin by 2.5% in the last 1.5 years, and our focus is still on to continue to expand those margin space. So yes, that's the target. We are looking at aiming at 14-15%. So it will take some time, I think, for us to reach there, maybe 1.5 to 2 years time. But yes, that's the target for us.
What kind of volume growth are you expecting to drive that kind of margin enhancement? Because the market is expecting, as you have indicated, 20% plus sales in the second half of this year.
If you look at few last quarters, I think after the 5 quarters of flat industry, in the last 3 quarters we have seen the growth of 20% plus happening in this industry. So going forward, we are expecting that 10 to 12% growth will continue to happen. Now a lot will depend when the government comes into power, as a stable government, and post-election scenario, how it really maps out. But as of now, I think the indications are all positive for the industry. So it's a good monsoon, so it will expect it to be a very good crop cycle going forward. So let's hope. I think our hope is we'll be able to deliver on those numbers.
Tell me a bit about your market share. Currently, how is the market share for the tractor industry stacked up, and where do you stand?
Well, we are today at about number 3 position, and the industry, growth is happening in the industry on a very regional basis. So today you see the growth happening more on the southern and western market, where we are not very strong player, but in the northern and central market, where the growth was happening about 3 months ago. So there the growth was happening, and we were able to come out on that. So I think it all will depend on how the regional growth pans out. So if it's a linear growth across India, yes, we'll be able to maintain our shares definitely, and will grow with the market. But as of now, we stand at number 3 position in the industry and domestic side.
The fact that you've just indicated that you expect your margins to go up from 12% to about 14-15%, what are the considerations behind it? Are you hoping that you would be able to reduce your debt by selling some land parcel, and that will benefit your cash flows, and that will also aid your margins? Is that the big assumption?
No, that has not been factored in the assumptions. I think the focus is more in terms of improving the product mix. The strategy is to go towards the premium product positioning and improving the product mix, improving the pricing, not discounting the products, focusing a lot on the cost reduction initiatives within the manpower side, on the material side. So I think all these initiatives put together have what has given us really the margin expansion so far, and we expect this will continue for another year and a half. And that's where is going to be the money coming from for us.
Also in terms of your export strategy right now, I mean, I'm just trying to assess for margins to improve and for sales growth to kick in, you need to also have some sort of, aside of the domestic market, also some sort of export strategy. Is that how you're looking at it forward, or you think domestic will pretty much drive growth for you?
No, it will be primarily domestic. Export is a very small segment for us as of now. And though we launched our international range of tractors recently in European market, we had a launch in Germany in November, and we expect that market to pick up. But the volume again will be primarily coming from the domestic side only. It will not be really export, at least not in the next 2 to 3 years. So going forward, yes, we are focusing a lot on export, but I think it will take some time to really come to that level where it will make a difference for us.
Are you getting a sense that the Indian tractor industry is getting slightly competitive? I was reading a research report over the weekend from Greaves, and they are also planning to move into the tractor business. Do you think that more and more global MNC players could also start setting up their shops in India?
Yeah, I think yes, in the long run that is possible, but as of now it's primarily the domestic players who have been dominating this scene as of now. So going forward, yes, the multinationals can come into the country, and we have been seeing a lot of potential which India holds as of now, and this penetration levels are pretty low for the industry. The mechanization is way below what the developed market has seen, so there is a lot of growth potential in the market today for all the players.
Are you looking at any kind of global tie-ups in terms of technical know-how and product innovation to introduce new products into the market?
Yes, we have done the tie-ups with the European players for designing of our tractors, and we are working on that, and we have also brought the specialty tractors into Indian market with the collaboration with an Italian manufacturer. So those tie-ups will continue. So wherever we see there's a product gaps and there's a technology requirement by the farmers, whether it's for their comfort or for their styling or for their technology needs, we'll definitely try to fill that up, and that's been the Escorts strategy in the past as well.
I want to understand two numbers from you. First, your cash flow, and then your total interest outgo. Because if you are making a case that operational efficiency will improve, your cash flows will improve and interest outgo will reduce. Could you give me a sense there?
Yeah, today our debt levels are close to 450 odd crores, including our working capital borrowings. And going forward, yes, we expect the debt level to come down, but since we have some capex requirement at least in the next 2 years more on the product side, so there we see some investment will continue to happen. So whatever debt repayment will happen in the next 2 years, we'll again be borrowing to that similar levels. So I think we'll still be keeping at the same debt level. Though on the working capital side, we see a lot of improvement happening in the operational margins going up. There we see the requirement of working capital going down. And as you know, the tractor industry per se is more a negative working capital industry. So the growth will not really need the sort of money which normally is required in a normal industry. So there we see some positivity there. But on the term debt side, which is today about 300 odd crores on our balance sheet, so that will continue to be there at least for next 2 years.
Final question from my side at least. Every time your stock has gone up, market rumors, they start surfacing up again that Escorts is looking at selling some of the non-core assets. They are looking at exiting out of the construction equipment business. Why don't you use this forum to clear the air?
No, I don't think there's any rumor as such, and the assets which we have or the assets which are being used today by the company, so it's not a surplus land which we are saying is getting sold off. And yes, there's a land bank which is there, which is getting used, but as and when we consolidate the plant, which is what we had declared in the past, so at that time we'll take a call whether we need the land for further growth, for further expansion, or for any new business activity, or there's an alternate use for that. But as of now, there's no plan now as such of any sale of on those non-core assets.
And just one final word on your distribution network as well as dealerships. How much are you going to be spending as a percentage of sales going forward? What's the plan there to improve the network?
See, on the selling side, we have about 6 to 7% total expenses happening on the sales side. On the distribution side, we have been appointing dealers and we've been expanding the network, but that's a continuous process, and we have been hiring dealers and replacing the weaker dealers and also opening new territories and appointing new dealers. But that has been a process which will continue at least for next 2 to 3 years. Today we got a network of about 750 odd dealers, and we are appointing about 100 odd dealers a year for the last 1.5 years, and this is continuing. So the process is on. So I think about 900 odd dealers will be the right dealer mix which we thought is required for Escorts level of volumes.
All right, we leave it at that, Mr. Madan. Thanks very much for joining us and giving us more insights to your business. That's Escorts. The stock, as Nikunj highlighted, has been a key performer in this year's trade that's been almost giving a return to investors of close to 90%. A strong one at that. Agriculture play, tractors business, clearly drawing interest from investors. 86% actually is the kind of return that Escorts has given at a price of 136, 137 coming in there, thereabouts.